Welcome to the latest edition of Actuary Voices, the podcast from the American Academy of Actuaries. I'm your host, David Nolan, the Senior Director of Marketing and Communications at the Academy. In this edition, I'll be speaking with Philip Mulder, who's the Assistant Professor of Risk and Insurance at the University of Wisconsin-Madison, and whose research interests encompass climate finance, real estate and household finance, environmental economics, and insurance. He's the inaugural winner of the American Academy of Actuaries Research Award. We'll be discussing his research and its implications for public policymakers. Philip, congratulations and welcome to Actuary Voices.
Thank you. Pleasure to be here.
Philip, why don't you tell us a little bit about yourself, and we'll take it from there.
Certainly. So right now, I'm an assistant professor of risk and insurance at the University of Wisconsin in the School of Business at Madison. Last year, I was a researcher in the Office of Financial Research at the Treasury. The year before that, I graduated with my PhD from Wharton. So what I study is disaster insurance, how that affects real estate markets, and how both those real estate markets and insurance markets are responding to increasing frequency and severity of disasters.
Right, that's a bit of a mouthful. I just want to say parenthetically, my daughter just graduated from University of Wisconsin-Madison.
Oh, wonderful.
So
Go Badgers.
Yes, indeed. And I'm a big fan. She graduated on time with honors. So we're in good shape. And are you yourself an actuary or is that in your future?
So I'm in a department here in Madison, the Risk and Insurance Department, where we do train a lot of folks who go on to become actuaries, both undergraduates and PhD and master's students. In addition, I think several of my colleagues are much more firmly in the actuary camp. I see myself as sort of straddling a world that encompasses both economics and actuarial science. You know, I come at a lot of these problems. My training is from economists and thinking about real estate and insurance markets from that perspective. But I'm very happy to find my research having applications and an audience among folks who more directly work in the actuarial space.
Great. And the reason you're on our podcast today is because you won an Academy Award. It may not have been for acting, but it is for research. You won the inaugural American Academy of Actuaries Research Award, and you will be receiving the award at our annual meeting. Congratulations.
Thank you.
And I was wondering if you could tell us a little bit about your research, because obviously it straddles, as you said, exactly what you just spoke about.
Sure. So What my research is focused on so far is flood insurance, and in particular, the National Flood Insurance Program in the United States. So this is probably an audience that will have a high degree of background knowledge on the NFIP, as it's called. But
let's not presume any knowledge.
Sure, yeah, exactly. So the NFIP is publicly run by the federal government, mainly managed through FEMA, Department of Homeland Security, and they are and have historically been the primary provider of flood insurance in the United States. So the way that this program works is that the Army Corps of Engineers is continually going out and creating flood maps. So they're trying to identify these areas that, according to historical data and their hydrological models, have at least a 1% chance of flooding each year. So the so-called 100-year floodplain. Then as a consumer, when you think about buying flood insurance for your home, the premium you face is going to depend on whether or not you are in this so-called floodplain. And a few important things happen with respect to this floodplain, right? The first is that your premiums are going to depend on your home's elevation. The second is that your lender, if you have a mortgage, is very likely going to tell you that you need to buy flood insurance. And the third is that there are going to be some requirements about how elevated your home has to be. Now, outside the floodplain, you can still get flood insurance, and in fact, it's going to be much cheaper. It's not going to depend on your elevation. Your lender will likely not require you to buy flood insurance. But the problem is that these flood maps are expensive to produce. There hasn't been a lot of funding for them historically, and risk is starting to change. And as a result, many of them are out of date. And there are a lot of very high-risk areas outside the floodplain. So that's just an introduction to my research question was, how does this flood map affect the way that homes are built and the demand that homeowners have for flood insurance? So there's a few important aspects that can go on with respect to the floodplain. The first is that obviously it's changing premiums. Any economist will tell you, you make something more expensive, people should buy less of it. But it's also giving people new information, right? It's telling you, you are high risk. The government thinks so, your lender thinks so. Here's this big map, you're in a blue area, you might flood. And the third thing it's doing is it's changing your incentives to elevate your home. So there's an adaptation angle to this as well, right? Developers might be more prone to build differently because it gets the buyers, the owners, cheaper flood insurance and protects them from this risk. So I wanted to disentangle those effects, right? What's changing in terms of adaptation? What's changing in terms of demand? How are people responding to these prices?
And can I just confirm that when you talk about elevation, you're not just talking about heights above sea or river level. You're also talking about whether your house is on stilts or elevated some other way.
That's exactly right. So your elevation with respect to this 100-year flood depth of just the ground that you're building on certainly affects your premium, but then you can get a more favorable premium by elevating your home. Yes, as you said, on stilts. And even, I think a lot of us have in the popular imagination, we picture these homes that are like right on the beach and they're on these massive wooden stilts. But actually, that describes a very small part of the floodplain, right? A lot of you take a look at a map of Miami-Dade County on the National Flood Hazard Layer. Half of Miami is in the floodplain. And most of we're talking very inland in relative terms, right? So in a lot of these homes, it can be a difference of just a foot or two. We're talking about, something that's subtle. Maybe instead of a slab foundation, you have some slightly taller pilings, and that can really reduce expected losses and your premium if you're in the floodplain. So what I find is that people do respond to this floodplain designation. So a big part of my study was conducting a survey. So I recruited homeowners who live in high-risk areas according to a flood risk model from the First Street Foundation, just sort of independently mapping flood risk, trying to fill in some of the gaps in the flood maps. So I recruited folks to fill out a survey online who live in some of these very high-risk areas. And I know their risk according to the First Street Foundation model. I know whether or not they're inside the floodplain. And I asked them if they have flood insurance. A few really interesting things came from this survey. The first is that, and this is something that's been talked about when people think about why is flood insurance take up generally kind of low. A lot of people thought that it was included as standard in their homeowner's policy. I think something like people who said, yes, I think I have flood insurance. So about 20 or 30% thought that was just in my home, my homeowners. And I had a few extra questions to try to really tease out, and I'm pretty confident that they really do believe that, and they don't realize you need separate coverage. But what was interesting is that share was much higher outside the floodplain and than inside the floodplain, right? So that's kind of a first channel through which the floodplain can help. It makes people realize you need to proactively go out and buy something separate. The second thing we did was, a lot of people inside the floodplain, of course, have flood insurance because their lender required it. And a lot of existing research on the NFIP has sort of treated these folks as probably very reluctant. They are perhaps dropping their coverage as soon as they can. Maybe this mandate isn't very well enforced. I was actually surprised to find that first, many of the folks, about 50% or so, reported that they were extremely likely to still buy flood insurance even if their lender didn't require it. And their flood reliefs reflected this, right? So I asked people, how likely do you think your home is to flood? How worried are you about flooding? How much would you be willing to pay for flood insurance? All these folks indicated that in their responses, they understood their risk and it correlated with what we were seeing in the First Street Foundation model.
And sorry, could you just explain the First Street Foundation model, please?
Yes. So the First Street Foundation model, right? A way you can think about what flood maps give us is they give us a 100-year flood depth in an area, right? How high would flooding be in this spot of land? And it has a 1 in 100 chance of being exceeded, that depth, right, every year. What First Street has done is they're giving you a whole range of return periods, right? So what does a 50-year flood look like? A 250-year flood, a 500-year flood. So right, that's capturing some risk that exists outside of the 100-year flood. The other unique thing about the way that First Street Foundation has built their model is that it's based on data that is, they've obviously done a lot of work to put it together. But what's unique about the way that the First Street Foundation has built their model is that it utilizes a lot of GIS data, a lot of historical tide gauge data, the most recent elevation data available, And altogether, what this means is they're able to be updating their model and keeping it more recent than these flood maps, which are very expensive and more costly to produce, require more surveys. Finally, the First Street Foundation has a built-in climate model. So they've incorporated projections from some of the standard climate models that are out there out through 2050 in terms of how those flood depths might vary, increase over time.
Right. And am I right in saying that a 100-year flood is not necessarily only going to happen once every 100 years? It's just that there's a 1% chance every year that it could happen.
That's right. And, and that's always a good basic stats lesson, something that I think the floodplain management community has some degree of angst about. You call it a 100-year flood, and that can perhaps lead to all sorts of cognitive biases around, it just happened, so we're not due for another 100 years, or I'm only going to live in the home for 15 years.
Right. So you're using the First Street Foundation's data as it's improved over what many flood maps are. And then you found that many of the people who live in floodplains were reasonably well educated about the risks and the need for insurance.
That's right. Or that at least it helped, right? There's probably always room for improvement. And, the take-up rate inside the floodplain that I found among my survey samples, about 58%. I think there's some folks out there whose perspective is, why not 100? Certainly, we see 100% take up for a lot of types of homeowners insurance. I think that gets into some more complicated problems about affordability, about the loading costs associated with a flood insurance policy. And about some cases, which, isn't the focus of my paper, but some cases where, if you talk to enough homeowners inside a floodplain, I saw this in the comments after the end of my survey, you'll run into some people who are pretty darn sure that they should not be inside the floodplain. So the big point of my paper is that an accurate flood map is at least giving people better information to make a choice for themselves. And, whether or not that's always the right choice is hard to say. And whether or not there's more information we could provide to help them make even better choices is certainly possible.
Apart from that, were there any findings from your survey that really surprised you?
Yeah, one finding that did surprise me was seeing, and I know we've touched on this a little bit, but seeing how many folks with mortgages still said that they would want to buy flood insurance even if their lender didn't require it. I think that was surprising. The other thing that was surprising is that of folks with mortgages inside the floodplain, 80% said that they currently did have flood insurance. When people try to think about enforcement of the mandatory purchase requirement, I've always seen a lot more pessimistic assessments of it. And that suggests there are many potential explanations for that remaining 20%. There are some cases where it may not be required even if you're inside the floodplain. But 80%, that's a lot better than some people who have thought that it's practically unenforced. One possibility is, one critique that I expect to get as I move this paper through the peer review process is that perhaps folks were just telling me what they thought I wanted to hear. But the overall take-up rates that I estimate from my survey sample align with what you see in the more aggregate data that the NFIP puts out. And in addition, their beliefs corresponded with both the flood risk of their home and whether or not they were choosing to buy flood insurance.
Right. And if people do not have flood insurance, does the NFIP sometimes bail them out anyway?
Yeah, well, so the NFIP would not. The NFIP is an insurer, and they're only paying if you've paid the premiums, like other insurers. The folks who might step in are FEMA, and also the SBA is a very important player in this space.
It's a small business administration.
Exactly, yeah. The Small Business Administration, who, yes, does provide loans to small businesses after disasters. Famously, I think the loans around the COVID disaster are to a large degree modeled off of the kind of lending they do after natural disasters.
Right.
However, actually, a lot of the SBA is providing loans to homeowners. So you can get a loan from the SBA and at generally favorable interest rates. So you can think of that as sort of an implicit disaster aid. In addition, you might get a payment subject to some income requirements that is to help you with basic rebuilding or temporary shelter from FEMA. There's the individual household grants. However, so it's important to emphasize these are small. I think many folks wouldn't qualify. The average grant size is maybe $7,000, I think. And the SBA loans, you do have to pay them back. Interest rate's not terrible, but you do have to pay them back. So if you're uninsured, you're still in a hole. So all of which is to say, and there's some good papers on this out there about who falls through the cracks with this disaster aid, what disaster aid might be doing to flood insurance take up. And it probably can't explain that gap, right? If you think that you're going to get completely bailed out after an uninsured loss, you're mistaken.
Right. And I've seen reports that a couple of jurisdictions, and I believe they're in Canada, have said, okay, either it's, I don't know if it's a private insurance company or the government, but they'll say, we'll bail you out once, or we'll pay the premium once, or we'll pay out on the premium once, but you can choose then to move or rebuild your house, but you're not getting insurance again. Are you familiar with those?
Not in the specific context in Canada.
Right.
What the NFIP does that's perhaps somewhat similar is that if you've received disaster aid inside the floodplain in the last 10 years, you have to carry flood insurance. Again, there's an open question around the enforcement of that requirement. I think they make you buy the policy as you receive the aid. But then I don't know that there's a systematic way they follow up to make sure you keep renewing.
Right.
And I think there has been some indication that over that 10-year period, you see some lapsation of those policies. It's an interesting idea. And I think it gets into the question of adaptation versus retreat.
Right.
Which I think is one that will have to be assessed. One way to think about it is that if we were to be risk grading homes, what you might expect to see is that right after your home floods, your premium goes way up, right? And that is what happens in a lot of cases with a lot of other types of homeowners insurance. And that's sort of a way to put the question into the homeowner's court, right?
Right.
Make you put your money where your mouth is if you really want to keep living here. But then this gets into equity issues and affordability issues. People who have lived in a place for a very long time. And also the role of insurance to some extent, right? The role of insurance is to help you maintain your standard of living when the dice don't come up right, when you suffer a bad turn of luck. And if getting flooded, because of an extreme weather event, perhaps suddenly makes your home unaffordable, well, that makes that insurance a lot less useful.
Right.
So there needs to be some thinking about how to make it so people can move and how to find that right balance between when perhaps a home can be rebuilt in a sustainable way and an economically efficient way versus when it might be better to abandon that parcel.
Sure. And more recently, we have seen in Florida that several insurance companies have apparently pulled out and no longer offer home insurance because obviously the threat of hurricanes as well as flooding and so on is much greater there. Do you see that as being something happening elsewhere in the future?
Sure. So, when I got into started studying flood insurance, a lot of people were kind of drawing this bright line between what I was doing versus private property and casualty insurance markets. And I think that line is becoming more and more blurry because the origin story of the NFIP is that it used to be a relatively standard market. And then a series of floods along the Mississippi River in the 1920s basically caused a mass bankruptcy of the insurers. There was a gap for about 50 years where no one was providing flood insurance. And the only way to recover from a flood was government disaster aid. And that was actually why the NFIP was born, was to try to reduce reliance on disaster aid and instead create regulations around the floodplain, make people pay for these insurance policies instead of just relying on ex post aid.
Sure.
So, but now, right, it's hurricane wind insurance in Florida, wildfire insurance in California. Increasingly, folks are ending up on these insurers of last resort through these states. And that's increasingly looking like a system that's beginning to resemble the NFIP. Now, what's going on in those markets is complicated, right? There's the element of increasing risk. There's also what the reinsurers are doing. Most listeners on this podcast especially will be familiar with reinsurance, but just in case, that is, these are large global insurers who write out effectively policies to insurers to cover their own catastrophic losses. And the Florida market has always been very reliant on reinsurance because There, the policies are underwritten by a lot of smaller players who don't have a national presence. So the reinsurers are both raising prices and cutting back on the amount of coverage they're willing to provide. There's rate regulation. Many insurers will tell you, right, they propose a rate increase and it's often capped or reduced, which means maybe they just leave the market altogether. And again, something you hear about in Florida is issues around litigation with claims, perhaps spurious claims driven by their own unique legal environment. And there's been some policy efforts in Florida to tamp down on that. But, despite all of these different issues and every state is having trouble in its own way, none of these are exactly shockingly new developments, right? There's always been regulators. There's always been some of these problems. But what I think's happened is both the uncertainty around risk and the amount of extreme events and the concentration of the risk is making these problems more binding. So while there are a lot of potential policy levers, these issues are coming to a fore, and I don't think one can will away the issue that risk and the changing environment with climate change has played in that.
Sure. This is a reminder that you're listening to Actuary Voices, the podcast from the American Academy of Actuaries. Please rate and subscribe to this podcast on your favorite podcast platform. You can learn more about the Academy at actuary.org, including our annual meeting Envision Tomorrow, which takes place in Washington, D.C., November 13th and 14th. And now, back to my conversation with Philip Mulder. Now, one of the reasons you won the award was because of the connection between your research and public policy. And public policy obviously is a very important issue for the American Academy of Actuaries. So what are the implications of the research you did for public policymakers?
What I think about a lot with the potential applications of my research is information. So the most surprising finding that I think I have is that people really do respond to information when you tell them plainly about their risk. That does change the actions they take in terms of insurance take-up and how they adapt their homes to risk. So I think that's a case where the government has a role to play because information can be a public good, right? You create maps that are easily interpretable by the folks making these decisions. You try to inform them with the best available models and data, and that's something that can improve the quality of decision making in this space. And it's something that the private market might not necessarily deliver. Right? Everyone's understandably holds their own risk models a little tightly to their chest in terms of how they set their own rates. But it's something where I don't think any of us see it as sustainable or want uninformed consumers going around as they pick their coverage choices or where to live or how to build their homes. So I do think that improving the quality of information around both current and future disaster risk could yield some really large economic benefits.
And do you see that there's a policy implication for policymakers actually enforcing new regulations that would, say, for example, update the flood maps more regularly?
Yeah, so I think that updating the flood maps more regularly, and actually what I want to talk a little bit about in this context is risk rating 2.0. So that's the new system that started, shortly after I gathered the data for my own paper. Was FEMA basically threw out their old premium system. So premiums are now based on catastrophic risk models and their extensive history of claims data, and they're actually estimating property by property risk. Now, this is great from a accuracy of premium setting perspective, but what I think it's still missing is that information component. What you see as a homeowner, if you're just trying to figure out the flood risk of maybe a home you're considering buying or that you currently live in, basically the information available to you is going to be the flood map. And that flood map is not necessarily going to reflect your premiums. In addition, in terms of regulations, the flood map is still what's setting the standards. How high do you need to build? Do you need to carry flood insurance with a mortgage? So we're going to be increasingly running into a situation where folks outside the floodplain, as far as they can tell, there's no public calculator where you can look up your risk rating 2.0 premium, you need to walk through that with an insurance agent. So you look up your home, you see you're not in a floodplain, you see minimal risk, and yet you find out your insurance premium is maybe $2,000-$3,000 a year. You're going to be confused. You might not be inclined to buy. Your lender's not going to require you to buy. Your home is likely going to be built very low. So that's, to me, a great low-hanging example of where, FEMA and FIP have the data, and they have the model up and running. And I think they just need to do a better job of getting that information out there and harmonizing regulations.
Right. I'm on the other side of that because when I first heard about flood insurance, went out and asked my insurer, would they offer it to me? And they said, "Oh, yes, of course." And I went, "Okay, let me think about it." And I live several hundred feet above sea level.
Yeah.
But they were still very happy to sell me flood insurance, even though I said to them, "Yeah, I think we're going to have bigger problems if my house floods."
Yeah. Perhaps.
Yes. But I was struck when I was reading your research, though, that certainly for people who live in floodplains, they were reasonably well informed and were making informed or somewhat informed decisions about whether to carry insurance and whether they felt that they were misplaced in the floodplain or that their house was safe, or that the insurance was not something they needed. It was based on information that they interpreted to give them that response. So that was somewhat reassuring for me, at least. That the idea that there are so many uninformed consumers out there who was not prevalent, at least in your research. And you surveyed, I think was it starting at high 2000s, but you ended up with about 700 usable responses. Is that right?
That's right.
Yeah.
So, I surveyed a lot of folks. Some people, just weren't willing to provide me their address in the response form. Others provided me an address, but it seemed a little fishy. Like maybe they were just clicking through the same thing on everything. We had an attention check in there where it was a very simple question like, hit this number, on all the responses. And instead we got random noise. Or maybe they reported they bought a home or that they lived in this home. And I asked, well, when did you buy it? Compared that to deeds records and, found. So those data quality checks were important to me.
Mm-hmm.
Right. And actually now I think about now in the era of ChatGPT, how I would running this survey again. Luckily, it was before ChatGPT, so I didn't have to worry that all my responses were coming from bots.
That's a pretty heavy lift, having to check deeds against each individual survey. Or were there tools that allowed you to do that?
Yeah, there were tools. I'm half my time I think of myself as kind of a real estate economist,
mm-hmm.
And that's actually a great data set, right, for thinking about climate risk. Is those data are all at your county recorder's office, and there are some firms that have put that together into usable formats for researchers. So it was, but I also don't want to downplay that. I was doing a lot of merging between addresses that folks put in and running those through APIs to get clean versions, and then merging that to another data set, trying to merge in these parcel IDs. It was. The fun thing about survey data is you get to ask exactly the questions you're interested in and try to find out new things that don't exist in any other data set.
Right.
But you have to do the work to make it usable.
Sure. And do you plan on following up with policymakers on this, or are you going to let your research stand and follow up some other way?
Well, I'm certainly hopeful that folks will start to notice it. And I'm always happy to talk about it with anyone who would be in a position to do anything about it. I wrote another paper very specifically about risk rating 2.0, and this point that we discussed about, that calculator is not publicly available. But, certainly as a researcher, I see myself as playing a role of providing information, right? Back to the theme of information. I see myself as trying to find some signals about what drives the way different people make decisions. And I'm not a policymaker, so ultimately, those decisions are left up to others.
Sure. Well, Philip, I very much look forward to meeting you at the American Academy of Actuaries annual meeting and to welcome you back to DC before you head off to the Wisconsin winter.
Yeah, no, absolutely. Well, thank you so much, David. And yeah, I'm really excited for the conference.
Great. Philip, thank you. Thank you for listening. Today, I was talking with Philip Mulder, the inaugural winner of the American Academy of Actuaries Research Award. You've been listening to Actuary Voices, the podcast on the American Academy of Actuaries. We are on the web at actuary.org, where you will find information about our annual meeting Envision Tomorrow, where Philip will receive his award. It takes place in Washington, D.C., November 13th and 14th. And please, don't forget to subscribe and rate this podcast on your preferred listening platform.